How do the markets fare in quarter three? What trends are unfolding this year? And what's on the horizon for the rest of the year? Nate, Condon, and Clint Walkner unearth the answers to those questions and more in this bonus episode of Gimme Some Truth, our quarter three market recap. Armed with data from JPMorgan's Guide to the Markets, Clint Nate explore the drivers of inflation, U.S. market outperformance, bonds, and more. So sit back and get ready for some truth.
Welcome back to Gimme Some Truth. Little Q3 recap today between Nate and myself. It's going to get real fun because we're going to talk about valuations, price-to-earnings ratios, forward price-to-earnings ratios, inflation expectations, interest rates, domestic versus international, stock returns and expected returns, and anything else that I missed there, Nate?
It just lost about half not even 80% of the audience just turned us off. Just moved on to a different podcast.
I love it. We'll come geek out with us. And
right.
I don't care about that 80%. I really care about that 20% that loves the Q3 recap.
I mean, it's timely because obviously Q3 ended, but it's more timely because the markets have experienced a little bit of uneasiness. A little trepidation in the markets in the third quarter. It's not just your garden variety fastball down the middle quarter.
That's true. It kind of.
I mean, we do some of these when it's just like, okay, yep, okay, a little up, a little down,
Yeah.
This is a little bit more, meat to this one.
Yeah, it kind of fell apart at the end there. There was a lot of selling that snowballed towards the end of the quarter, and so it kind of fell with a thud there at the end of Q3. And so, a lot of people are wondering, well, what's next? And I think that the best spot to look at when you go through these bad quarters is where are we at now for valuations? And, we look at a lot of different metrics, but price to earnings is probably the most common because it's the one that many people follow. And so I think that it's worth looking into a little bit about where we're at now, historically speaking, with price to earnings ratios, because obviously, one thing has to give in each part of the equation to drive stock prices. And so generally, when earnings expectations start to fall, obviously prices will start to fall. When earnings start to perk up, then, prices usually rise, or at least the expectations of those earnings, because it's obviously a forecasting thing. The market moves in anticipation of what it thinks it's going to do. So, if we think earnings are going to be good for a particular company, say Apple, we think that earnings are going to be good for Apple, well, then the stock price will move to reflect that, and that forecasting. And when that doesn't come to fruition, then we'll see the price fall. So,
well, let's talk about that briefly, because I think that people don't. I don't want to assume that people don't understand that. I want to make sure that people do understand that, right? So when we talk about valuations, I mean, stocks in general, for the most part, are priced based on what people think the future earnings of that company will be, right? I mean, that's basically what it is. I don't think a lot of people understand that. Like if a stock goes up in value, up in stock price from $30 a share to $40 a share, that can happen for a myriad of reasons. But one of the main reasons, and one of the main reasons why kind of pure fundamentalists would tell us that happened is why? Because people think that the earnings are going to be higher in the future than they were up to that point, right? I mean, that's essentially when you buy it and when you have a stock price go up in value, your stock price went up because the general consensus of stock traders thought that the earnings of that company will be higher in the next quarter, 2 quarters, 5 quarters, whatever it is, than they were at the time that the stock was at $30 a share.
That's exactly right. Let's take Apple, for example. If Apple, never produced another phone,
right,
or computer, if they just ceased operations, the stock price would essentially be zero, right?
Right.
And I don't care at this point what their previous earnings or anything were. It's just a forecasting guide, but really I'm buying future earnings.
Right. And to take that one step further, let's say that you could assume that Apple's earnings would be exactly the same for every year moving forward as they are today. Theoretically, the stock price would never change. I mean, that it would, because there are a few other factors, but if you purely look at it from how fundamentalists look at stock trading, if they know that a stock's earnings are going to be exactly the same, which nobody would know, it's a hypothetical, obviously, but if somebody knew that, then the stock price would be stagnant for as long as that constant plays out.
That's correct. The earnings and the price would essentially be stabilized.
Right. So when they talk about the market being efficient, right, that's what they're referring to, right, is the idea that if these things were known, the stock price, if you knew the future earnings of every single company in the index, you could predict the stock price of every single stock in the index almost to the penny. That's the definition of, quote, an efficient market, or what we assume as a well-balanced market.
That's right. So if we go back to today, where price to earnings ratios are at, previously, if we saw, say, for example, last year valuations were very stretched. The price to earnings ratio was quite high relative to historical averages. And Nate, I think you have the chart on this here as far as where price to earnings ratios are right now. And we see now that things are a lot more fairly valued than they were previously, and arguably maybe even a little undervalued. You have some stats there for us, Nate.
Right. So we'll Danny, am I misleading our listeners and watchers? People are going to see these charts, yes, on the on the visual aspect of this recording. This comes from JPMorgan Asset Management. They do a really good job of putting together what we believe to be some of the best outputs. Things that people can get their arms around. It's not too in the weeds. It's usable for somebody that doesn't have a PhD in finance. The 25-year average within the S&P 500 on what Clint's been referring to, the forward-looking PE ratio. So again, the forward-looking price versus earnings ratio. The average over the last 25 years has been 16.83. Okay, so if we just use that as kind of a mark, right, and then use that as comparison, right now, October 3rd of 2022, JPMorgan has it at the S&P at 15.51. So again, 16.83 is a 25-year average, and we're now sitting at 15.51.
So a little undervaluation, when we discuss what historical means have been. So,
and we'd say
historical averages.
Yeah, and a little, maybe even kind of getting into the area of pushing a lot, right? I mean, you're 16.8 versus 15.5. You're starting to move away from that average a decent amount.
Yeah, and then we had a little rally over the last week or so, and then it all dissipated at the end of the week too. Fell apart. So one of the things to watch when we're watching these markets is oftentimes when you have a lot of negative sentiment and the momentum is negative, you'll see a lot of the same things. And we've said this before in prior podcasts, but you'll see the end of the day, everything falls apart. You'll see the market be able to, is unable to sustain a rally, and you have this negative momentum going on. And that's what we're seeing currently right now in the markets. It's just a ton of negative momentum. And so there's not a lot of catalyst for the stocks to rise. And so, the market may stay undervalued for a protracted period of time. And right now it appears the market's on a slight sale and perhaps turning into a big sale as we go along here. So the earnings will have to continue to support that, though. And I think that's a reason why you're seeing this kind of undervaluation right now, is that we are literally seeing the expectations melt away and get the sentiment getting worse and worse right now as far as where we are going to see earnings, just due to the fact that the Fed is moving fairly aggressively and raising interest rates right now and trying to tamp down inflation.
Yeah, I think in some cases the traders within the industry just in general sometimes get a little bullheaded and they can kind of miss the forest of the tree sometimes. And I think the Fed's done as good of a job as possible at literally beating the traders over the head with the idea that this is not slowing down. We're not kind of doing this to just kind of, quote, see what happens. We're getting this under control, this being inflation, by way of rate increases. And, it's weird because every time the Fed says that and says that as blatantly as the Fed says anything, 3 weeks later, 2 weeks later, there's a story that'll come out that the traders are on to some other line of thinking because of some justification as to why the Fed's going to slow down. And then the Fed comes out again and beats them over the head again and says, no, we're not messing around. We're doing this. And again, I mean, it's just like they keep falling for the same, trick over and over, but it's not a trick. They just keep believing, just unsubstantiated kind of rumor, gossipy stuff, and don't listen to the Fed for what the Fed is saying. I don't know, in our careers, I don't know that I can remember a time that the Fed has ever spoken as plainly as they've spoken in the last 6 months, 3 months probably is a better way to say it, in regard to what they're going to do for inflation, and the street just still doesn't seem to believe them.
They always wait for the pause moment, but
right.
Inflation hasn't come down in a marked manner yet. We're still way above. I mean, we're seeing Jeffrey Gundlach, it's really smart people coming on and saying that we're going to have rate cuts next year already, like they're going to reverse course that quickly. I'm very skeptical of that. Perhaps we'll have to go back and correct everything we've said, but I just find that to be really quick. We'd have to go through quite a deep recession if we were to see the Fed reverse course that quickly. That means that they way overshot it. We went into a really quick, deep, dire recession. I think with the way that the Fed has telegraphed everything, though, in my opinion, I just think that it's just not going to happen that fast. And I agree with you, Nate, 100%. The Fed has been very telegraphed in all of their moves, and I don't anticipate them to slow it down at all. I think that they're going to continue to raise interest rates until they reach a pause moment. They've even kind of telegraphed that next year they're likely to pause sometime early next year, and they're going to just see how this all works in. I mean, if we look back at inflation drivers and expectations, and I look at the chart here and inflation expectations, the professional forecasters are saying in September 2022 that our inflation expectations over the next 5 years are going to be 2.9%. Consumer expectations are 2.7%. I think it's probably over the next 5 years likely to be higher than that. We just came down, in about, June of 2022, we had inflation numbers at about 9.1%. That appears to be the peak. But then, it's gone down a little bit since then, but we're still at like 8.3% in August. So, I mean, it's not like we've gone from 9.1 down to, 5 or 6%. And that's year over year change. So it takes some time to bake those in. But we are seeing definitely higher inflation than we've seen in the last, 35, 40 years. And the Fed is going to have to make continued interest rate increases a fulcrum to help bring that inflation down.
Yeah, I agree. And I think that you and I are big believers in the idea of regression to the mean, and the further something pushes away from, its mean, the more likely it is to regress back to it. And I think that as a kind of the next step in that logic is the further something moves away, moving back incrementally to the mean, it can move back big steps, but as it gets closer to the mean, it takes more pressure to get it down to the mean. So my point here is, if it peaked at 9, right, I could easily see it falling to 7 or to 6. But the idea that it's going to go from 9 to 3, right? Because I think what happens is the amount of effort that it takes to get it to go from 9 to 7 is not the same amount of effort that it takes to get to go from 5 to 3. It takes more effort from 5 to 3 than it does from 9 to 7, because 9's so far out there that for it to drop from 9 to 7, you go, okay, that didn't take much. The Fed kind of pushes it a little bit and indicates a few things. But as they say, inflation gets stubborn, and it gets stubborn the closer it gets to kind of back toward normal points. So this idea that we're just going to go from 9 back down to sub 3, it's going to get stubborn at 5 or 6, even 4. And I think the Fed's going to have a hard time pushing through that. And I think the Fed knows that. And so I think that's why they're being so clear with this, is because for them to get it to drop 200 basis points off to where it is right now would be a big move. But that's still incredibly high inflation. So you can't, and they know they can't maintain that. So this just seems like this is going to take a lot more effort. And you and I, respect a guy like, Jeffrey a lot. But rate cuts? I mean, holy cow. Like, it's really going to go from 9 down to what, sub 2.5, to the extent that they can start cutting rates again.
They were even mentioning inflation.
It just seems, I don't understand that. I don't understand how that logic works.
Yeah, we'd have to have a super deep recession, and it would have to start very quickly. I don't think we're in, we might be in like a technical recession right now. I don't think we're in some sort of deep recession right now at all. But, I just see it as being, like you talked about, the sticky inflation. And I've written a blog post on this, but there are components that just stay around longer, and those are wage gains. Those are rents that go up. Those are sticky items, right?
Right.
So,
sticky meaning that they're not going to be, they're not just going to fall.
That's exactly right. So once they become a component of that inflation, it's hard for it not to continue to be baked in. So, for example, we can't just go and go to Dan and be like, hey, Dan, we're just going to cut your salary now by 10%. We kind of overshot you a little bit, which we probably have. But, maybe it's...
We probably could do that.
Maybe we could. We're contributing to bringing down inflation by cutting Dan's salary.
Everybody's got to pull in the right direction, Dan.
There you go. So, I think that there's just a situation.
By the way, that'd be a great band name too. Sticky Inflation.
Sticky.
That'd be a great
What kind of genre do you think that is?
Probably like industrial metal, something like that.
I like that. I was thinking ska. But,
sure. Okay.
Right.
Yeah, right. I like that. Horn section. Sure.
Right. Yeah. Sticky Inflation. Some guy's got like a pork pie hat on and just going to town.
Sure.
So when we talk about other spots that we see, I do think that there are always opportunities in every sort of market. And I think one of the hardest places to go right now is saying, well, okay, in the stock market, where do we have any sort of value, and how can we extract extra rate of return from there, or where are there places where historically you're seeing a little bit more undervaluation? And if we look at it, usually, we look at companies as value-oriented companies, which tend to be more dividend-paying companies, tend to be more energy companies or financials or utilities. And then you have your growth-oriented companies. I think a lot of people know what that is, but mostly technology companies, companies that are growing their revenue very quickly. Oftentimes, a lot of them don't even have much of a short-term profit motive. They have a long-term profit motive, but the growth of their company is more of a priority. Those tend to have higher price to earnings
growth companies can turn into value companies. I think that's something that a lot of people don't understand. I mean, Microsoft at this point, you could almost argue is, maybe not purely a value company, but I mean, it's kind of almost stuck in the middle now, and that's kind of the evolution of big tech companies.
Yeah, it's very true. And it's a great point. We do have some kind of value-oriented technology companies in that they pay dividends. They don't grow as fast, but they're just tried and true. Maybe Apple's transitioning into that. So if we look at that and just say, historically speaking, where are we at growth versus value? Our long-term price to earnings ratio average, it's about 14.09 on value-oriented companies, about 20.72 on growth-oriented companies. That's our forward PE. The current valuation on value-oriented companies, 12.44. And for growth, 20.81. So the long-term average almost exactly matches on the long-term growth side. But on the large cap growth, I should say. And then on large cap value, there's a bit of a disconnect there as well. It appears that if you're looking at, is growth cheap? Well, the answer is no. Seems to be pretty fairly valued. Is value cheap? And I would argue, yes, value-oriented companies are a little bit inexpensive relative to our historical norms. So perhaps a tilt to value in a portfolios may make some sense. Value-oriented companies also tend to hold up better in rising interest rate environments, whereas technology companies tend to do very poorly in those environments. So,
and I think that's you brought up a good point. And I think so people understand kind of money management in the times that we're in right now. Rate of return and kind of eking out better rate of return is not always spoken at on the positive side of the scale, right? I think that's a point a lot of people don't quite understand is, when you talk about rate of return in a market like this, we're not necessarily talking about positive rate of return. In a lot of ways, what we're talking about is how can you lose less? How can you defense better And I know people go, that's almost a ridiculous statement. I should feel good about losing less money. And the answer is yes, you should, because we don't always equate our total gains within a portfolio over a period of time by just looking at the positive years. When we look at losing less in the negative years, it makes our overall rate of return better. So it's not just a focus on rate of return to the positive. It's also saying, how do you play better defense when the market's going through what it's going through right now?
That's exactly right. There are definitely periods of time where value shines. The tech bust is one of the spots that value shined in, and perhaps we're going through a mini tech bust.
Is it shined or shown? Danny, is it shown? I don't think it's shoneth. The ACT board is going to want their test back from your results if that's how we feel about.
He claims he was like a 31 or something.
32, don't sell him short. 32.
32.
Gosh,
that's pretty good.
I'd have a T-shirt made.
It's pretty good. Did you take it twice and add the scores up?
I still don't know if I would get to a 32.
Now you could just use the excuse, I'm not a very good test taker.
That's right, exactly. That wasn't around when we took it. That wasn't a thing when you and I took the ACT. There was no such thing as a bad test taker. Anyways, we digress.
Actually, there's one slide that actually stuck out to me a lot, and I wanted to touch on this because we've talked about kind of large value, large growth, and one of the spots that stood out to me most, the current price-to-earnings ratio as a percentage of the 20-year average. So, like large blend is at 100.3%. So in other words, the current price to earnings is at 15.5, and the 20-year average of the price to earnings is about 15.5. Okay. So if we do use that as a for example, we can look at where things might be overvalued and undervalued. So if we look at large value, it's at 91%. So it's kind of what I just talked about is large value looks to be slightly undervalued, and growth is at about 112%. So, maybe slightly overvalued there. Blend is like spot on. So if we look, one of the most interesting places is large growth is at 112. Small growth is at 65.9%.
Wow.
Yeah. So, you're kind of wondering, like, why is that? Well, maybe they're the most interest rate sensitive companies.
They have to borrow a lot of money.
Yep.
Especially growth, small growth. They have to borrow a lot to stay in business.
Perhaps lower credit quality.
Right. They have to pay more for their debt when they borrow it. Costs them more money. Revenue's lower then.
More uncertainty probably in those small companies. Obviously, they might be some going concerns over that. Whereas you contrast that with small value, it's 80.6%. So still on the, arguably undervalued side, but but large or small growth being at 65.9 when large growth is at 112. That's a total anomaly to me.
Yeah, and I think it speaks to the idea that in markets like this, there's the old adage of flight to safety, right? And we identify, and correctly so, safety to reside in bigger companies. It's almost where the phrase it didn't come out of 08 or 09, but more or less came out of 08 or 09, but too big to fail, right? Because it's so big, the institution or the organization is such a large institution that they can't fail. That's an interesting. I would have guessed, and I'm assuming you would have as well, that those numbers would have trended that way. I think we both would have been shocked that they've trended that far that way, right? To be only at 60 or 65% of, kind of where you would assume, if 100 is kind of balanced, if you will, or that's kind of where the scale is, has the equal weight on both sides of it, to be at 65% of that is, that's a pretty big deviation from what you would guess.
That was surprising to me.
That's pretty surprising. Yeah. And I think that we've always talked about the down markets help to illuminate and help us see better, maybe some things within the markets that we would not have seen had we not gone through those down markets. And I think that's one of the positives that come from down markets. I've said this before, and it's hard to know that this is true because, it's hard to know how history would have played out, but a pretty good bet that we would not have known as well who Jeffrey Madoff.
You've been watching Jeffrey Dahmer.
I have. That's exactly what
my wife's been watching a lot of Jeffrey Dahmer lately, and it's crazy.
We wouldn't have known who Madoff was, at least to the extent that he was, if 08, 09 didn't happen. And so when we have times like this where we go through these uglinesses in the market, it helps us to understand where vulnerability is. It helps us to understand where fraud maybe is. It helps us to understand what is strong actually versus what is perceived to be strong, right? I think that in some cases we look at the companies that we like because we like them for whatever reason. They're local companies, or our families like them, or whatever it is. And so they're a quote good, strong company. Well, until you go through a time like this and realize, holy cow, maybe not as strong as I thought. So in a way, this is the market's kind of defense that it has. It's the immune system of the market, is to go through times like this and kind of root out those areas that have maybe been forgotten about or looked past, and maybe they shouldn't have. And you look at small growth and go, maybe money should find itself to small growth. Mm-hmm. Maybe that's an opportunity that all of a sudden we wouldn't have really known about had we gone through this down market. I mean, right. You would have really had to look at the numbers to find that, whereas in a down market like this, all of a sudden it becomes kind of a blinking red light.
Well, and usually small caps are the ones that take us out of the recession,
right,
into that next bull market.
Right.
So I think what those numbers are telling us is that there's a definite anticipation of a recession.
Right.
Those numbers tell us right now that there is a flight to safety.
Right.
Money has gone to large companies at the expense likely of small companies. And when we do see the next rally, the next bull market, it will likely be these small companies that lead us out of it. And so I think that, maybe it's a little early to go there now, but it's something to keep your eye on. If you're an investor, or as we're going through portfolio management, we always have large, medium, and small companies in all of our portfolios, but it's something to look at a little bit stronger and saying, should we allocate a little more to these? So, we watch.
But this is not an advertisement to run out tomorrow and load up on a bunch of small caps. Let's be clear on that. No. That's not what we're saying. But what we are saying is that, to your point, Clint, small caps generally lead us out of ugly times. However, that leading out of ugly times might start tomorrow. It might start 2 years from tomorrow. We don't really know. So,
yeah, I think we're still a ways away from what we might see as a recession. So we're going to have to see how far the Fed does actually have to go to tamp down inflation, and that will have a big bearing on whether we see a recession and or how deep it is. So.
All right, let's. Should
we talk some fixed income?
That's just what I was going to.
All right, let's do that.
Let's talk about some bond markets.
So let me pose a question to you, Nate. I'm going to give you a quiz because I don't know if you've seen this slide.
Okay.
Number of times since 1976 we have seen negative bond markets, and we'll assume that this year is one of them.
When we say negative bond markets, we're saying the ag or something.
Yeah, the Bloomberg U.S. Aggregate Bond Index.
Number of times, including this year, assuming this year was negative, this year will finish negative, that the bond market has been negative since 76?
1976.
I'm going to say 4, and I'm going to say 4 because I'm going to say 2 of those happened in the 70s. I'm going to say 1 happened in the 80s, and I'm going to say 1 happened in the early 90s. So maybe 5, maybe 5.
Okay, you're right on the 5, which is amazing. Right on the 5. However, not right on that. The 70s, 76, all the way to like 95, if I'm right on the chart, because I'm looking at the chart here just offhand. Only 1 down market, minus 3%.
And what year was that?
It was like 95.
Okay, so I did have that
maybe
right.
94.
Okay, so it must have been earlier in the 70s that the ugliness happened. It must have been rebounding by then. Okay.
And how many times? So now we have 5 down years in there. How many times has it been down more than 5%?
It's this year, obviously, and I'll say 1 more, but I'm not confident on that. It might be just this year.
Just this year.
Yeah. Okay.
Just this year. So the worst rate of return year, it was in that like 94, 95 range, negative 3%. Yeah. There's a negative 1, a negative 2, and a negative 2 last year. We're at somewhere around negative 14. So
say that again. We're around where?
Like around -14.
-14. And we've had, and this is the only year that it's been down more than 5 since 1976, and it's not down 5.1, it's down 14.
Yeah.
So and I don't think people understand how bad the bond market is right now.
Unprecedented.
It's that unfortunately that word gets said a lot inaccurately in our society. This literally is unprecedented to have a drop of this level. This always makes me nervous when Dan's moving cameras around. This makes me believe that like he didn't charge a battery or something happened. That's what happened here, right?
It's got a lot of
something happened here, especially when we switch to the cell phone. Like that, that's never good. That's Danny hitting the backup plan. No, I digress. So the down market is, that's a word that kind of encompasses a lot of things, right? -1, -2, -5, -14. -14 is a down market, you know, and then another word after that, because it's not clearly represented by just saying a down bond market. I mean, this is as bad as anybody has seen a start to a bond market that is alive today.
That's correct.
And potentially as old as anybody who's alive today's their next generation, their lifetimes as well.
Might be 2 generations. So it's been a lot. I think it was 18 something that, you know, in the 1800s when we saw a bond market this bad. I just think that correlation that we're seeing between stocks and bonds is extreme.
Yeah.
And we've never really seen this in our investing lifetime. So it's not providing the ballast that it normally does. When the stock market usually goes down, then the bond market usually at least holds the line or oftentimes increases. This is totally not what's happening. So investors, whether they're conservative investors or moderate growth investors, may actually obtain the same rate of return.
Yeah, I'm trying.
It's totally uncommon.
I've been trying to come up with an analogy on this because I think that it's helpful for people to understand and to kind of see the market as a somewhat of a finite amount of money that's invested within stocks, bonds, cash. It's not purely finite. It's not down to the penny, obviously, because some money comes out of investments and some money goes in every day. But for the most part, it's a similar amount of money that's invested kind of at all times. And so what happens is the money doesn't fly out of the market generally when the market goes bad, stock market goes bad. It does what? It goes into bonds, right? So it doesn't flow out. It just flows to a different part of the market, right? So it's kind of like if you were holding a bucket of water and you tilted it to the right, you know, the water would rise on the right side of the bucket and go down on the left side of the bucket, right? That's kind of what happens, right? When stocks rally, bonds, you know, money comes out of bonds and goes into stocks. Tip the bucket the other way, you know, when stocks don't do well, you know, money flows out of there and goes into the bond market. The problem here is the stock and bond market have fallen at the same time. The same amount of money, more or less, in the market right now in all investments, but everything is losing. So you don't have that ability. It's not the teeter-totter idea of when this goes down, money flows out of this and it flows into this, which makes this go up. And conversely, that's not happening right now because you can't flow money the other direction and make that side go up because everything is getting hit right now. So it's just unprecedented to have as bad of a stock market and as bad of a bond market happening at the same time.
It is. And commodities also, which were on a big rally earlier in the year, have dissipated as well. Part of that's energy prices coming back down. Real estate hasn't performed very well either. As far as an asset class, a lot of those are real estate investment trusts. Because of rising interest rates, those tend to be very interest rate sensitive. So everything's gotten hit all at the same time. So the one thing, cash is king now instead of being trash. So cash has been trash for a long time. Now it's kind of king.
Right.
We'll see how long that persists. But a good benefit to having all of this sort of thing happen in the bond market. And you've essentially erased 10 years of rates of return in the bond market with what's happened, that we will see higher yields going forward and there'll be a natural healing of the bond market. So, that's why we are a little reticent in, not moving around our bond exposure a super amount right now, because we do anticipate that yields will perk up over time. or maybe we will see interest rate cuts in the future, and the longer dated bonds then will have their day in the sun again. So we'll see what happens there. Jeff Gunlock's super bullish on bonds right now. I thought that was an interesting thing that I read the other day. So check out maybe some of his comments. I think he's a really good bond manager and has done he does a ton of research. He's really, really well spoken. So, and if we shift gears one more time, Nate, in pivoting a little bit from the stock and bond markets, let's talk for a moment a little bit about international versus domestic. I feel like every year we say this, that the international markets are undervalued relative to the domestic markets. And so I saw this slide here and I thought this was great because it seems like forever we've been saying that. And so when I look at U.S. performance versus international stock performance, the outperformance of the U.S. stock market has been 210% from about 2007 to today, and 15 years of sustained outperformance. We talk about unprecedented.
Between U.S. to international.
Between U.S. to international. This chart started in 1971 that they gave us. The longest other one that we saw here was international outperformed about 7.3 years and only about 64%. So this has been just a massive outperformance of U.S. stocks for a protracted period of time. At some point that will cease, but who knows? Maybe it'll be another 15 years. I don't know. But right now when we talk about standard deviations of outperformance, this has been really, really a large standard deviation away from the norm.
Yeah, and again, I mean, it's a hard one for us because, again, you and I believe in the idea that things will kind of find their way back to their historical averages. I think the international markets they've just been hit, starting in 08, 07, 08, right? Those markets did not recover as fast as the U.S. markets did. 08, 09. They didn't recover as fast out of 08, 09. They kind of lagged into the kind of mid-teens of the century. Then COVID hit, obviously, that shook them up. Brexit has been an unstabilizing factor. Strengthening of the dollar has hit them. I think it's just they've just been hit kind of one time after another with these maybe not unforeseen events, but just these events that just keep kind of resetting them back to, okay, now they're going to start to grow again. And then, they in some cases do grow a little bit, or in some cases kind of just still muddle along, and then they get hit again. And then it's, okay, now we're going to reset. Okay, now it's going to, and then it just get hit again. And I think some of that too is when you look at the political environment in Europe, somewhat unstable. It seems like they're trying to find their feet a little bit. You have a wave a little bit of push toward conservative politics. In Italy, that happened, and in other places that's kind of perking up in Europe. That's not a very that's not a common, or a recent trend that we can point to and go, okay, yeah, but that happened again over here and again over here. I mean, that's new-ish, for Europe. I'm not sure where this all shakes out. This will be very interesting to see. I would bet, because I tend to bet toward averages, that that we're going to see outperformance of Europe of international versus U.S. in the next 5 to 10 years, simply because of the historical data. I don't know. I feel comfortable about that bet, though. Even though it's been 15 years of outperformance, I still don't know that it doesn't last another 5 or 10 years.
It may.
Which just sounds crazy to say, but I would almost bet that we still see outperformance on the U.S. side over the next 5 to 10 years.
You think so, huh?
I somewhat think so, but I wouldn't leverage a bunch of money on it. I would simply say that there's not a lot in my head that I look at and go, yeah, now they're poised. Okay, the rocket's on the launch pad. We're counting down. Europe primarily going to lead the international world to bigger and better things over the next 5 to 10 years. I don't see that. I'm not saying it can't happen. I just don't know that I see that right now.
Well, if we look at a couple data points, if we look at Europe specifically and their current price earnings ratio, it's at about 10.5. And
so cheap.
Historically speaking, 14.6.
It's so cheap right now. It's so cheap. And that's the reason why we look at these things and we scratch our heads and try to understand how, because typically what happens is when something gets cheap enough, the buyers come in. The buyers come in and they buy it, and therefore the price goes up, and therefore it rallies and on and on and on, right? It's just been so cheap for so long. I just don't understand it. It's like they have the clearance sign outside in the window and just nobody's walking through the door. I don't quite understand. And it's not like it's clearance of selling a bunch of things that nobody wants. You're talking about very strong economies that have very solid corporations, very solid balance sheets, but yet it just doesn't seem like anybody wants to buy the prices up. I don't understand what that is.
Yeah, part of that could be the dollar being very strong. Another component of it, and we'll have to ask some of the members of the international team on this, but I think currency definitely has a big thing on it. So, if we do see the dollar get weaker, I think we'll see better international returns. I mean, that is how that actually works. So I do believe that we could get some of that tailwind. Right now, it's a big headwind in your face if you're investing internationally, and that could become a tailwind as soon as we start to see, they're moving their interest rates up as well, pretty much across Europe. So maybe they get, maybe things flip. We start cutting rates and they're continuing to raise rates, and all of a sudden you'll see a strengthening of those other currencies. The other thing that we could see is just sort of that mean reversion of saying, well, now that is a catalyst, and now we see some momentum towards that, and the trades start going that way. I mean, it's a massive difference between the averages and what we're seeing right now. So I would bet that we will see international outperform, but I feel like I've been super wrong on that for the last 10 years. So,
I think it's the same old story too. I think that, people just aren't traveling yet, especially internationally, as much as they were pre-COVID. I think that has to turn itself around. I think the strong dollar does help that side of it. But I still don't think you're seeing people travel as much as they did before. And I do think supply chain problems are hurting Europe potentially more than the U.S. only from the standpoint that the U.S. has the depth and breadth to be able to potentially mitigate those situations better than does each of the individual countries that make up Europe in general or the Asian countries. I think it's difficult to kind of fix some of the supply chain issues when you don't have the volume that you have in the U.S. I think it's easier in some cases to do that. You can maybe go to different suppliers. You can maybe make it yourself. You can do different things, and I don't know that necessarily every country in Europe or in the developed world primarily has the ability to switch gears maybe as quickly as the U.S. has been able to do. I agree with you from the extent that I think when those work itself out, and we're already starting to see the supply chain issues somewhat work themselves out, that could be that kind of push that the international side needs to start to outperform the U.S. But
and we'd be remiss to not to state that there's also a war going on as well. So obviously that has an impact economically to the whole region, because as it's closer and closer to your doorstep, it's obviously going to have an economic impact in the country as well. So, obviously the U.S. being a bit away from that, not involved in it, but, it's away from it a little bit more. And so it has a little less of an impact there as well. So I think, to wrap up kind of the Q3 recap is saying, look, stocks are not doing well right now, but also bonds are not doing well. Diversification's not really working right now, and it will work over time. But again, we're in a situation where we're going through a big reset in the bond markets. We are seeing higher rates. That's good. That's opportunistic. We are seeing some spots where we do think that there is some valuation attractiveness in equities. But people need to start to sit into and understand that these things take time, and it will take a little bit of, the time for the inflation rates to come down, for us potentially to go into recession. The stock market will not start doing sustained rallies until the market feels like the worst is over, and the worst is probably not here yet.
And that's a great point. We always say that the stock market tends to lead or tends to rally significantly sooner than does the economy in general coming out of recession. Said another way, you're likely to see the stock market start to move up and start to appreciate again well before the presumed recession is over. But I think that we have some room to fall here before we get to that point. And that doesn't mean that we should all hit the panic button. What it does mean is that we should just we should have some appreciation for the fact that while it's fallen a lot, valuations still are not, screamingly low right now. And maybe it falls another 5%, maybe it falls another 15%, we don't know. But it just feels like it's got to give back a little bit more until that rally kicks in.
I would tend to agree with that thesis, and I think that we're in the middle of, what we just call bear market rallies. You'll see some, you'll feel relieved as an investor. You go, okay, well, maybe the worst is over. And then you'll have this trap where it's not, and then it'll hit a lower low, and you'll be like, ugh, and it'll be frustrating. There's no question about that. I mean, this could be a multiple year thing. We might see a couple years that are down in a row. That wouldn't surprise me. So, as investors, we just have to understand that the calendar doesn't care. It doesn't mean that, just because the calendar flips to 2023 doesn't mean that everything's going to be all better in 2023. The stock market will recover whenever earnings are good and some of these items that are drags on earnings, start to dissipate. So supply chains, wars, inflation, all of those sorts of things that are around an overheated economy. Once that works its way out, you'll start to see stock prices go back up and sustain those gains.
Yeah, and to answer the question that some people might have in their heads right now, which is, okay, well, if you guys believe this, then why aren't you, getting more conservative? Why aren't you shifting and getting into protectionary mode? And the frank answer to that question is because we've been wrong before. And we could be wrong this time, i.e. the market could fall another 3 or 4 or 5%. Something could kick it in, it rallies again, and it rallies right when we're moving more conservative. That's the reason why we're not what are called tactical money managers. We believe in diversification. We believe in long-term fundamentals. Long-term fundamentals say this is how you manage money during down markets. You play better defense. You don't tactically shift to cash and then try to shift back in. That's not prudent money management, at least the way we see the world. So us playing good defense in times like this will set us up for when, because nobody knows when the market decides to turn and go the other direction.
Yeah, and it's definitely not a screaming buy right now either to advocate that, and it's not the metrics would not tell us that the market is extremely overvalued either. So I think just being prudent in your money management and understanding that's a long game. The only time when you would want to depart from that would be if you really need money in the next couple of years. Well, right now you've got to discuss that strategy with your financial advisor and come up with a plan on how you're going to mitigate that.
Yep.
Because otherwise, if you had to get money out over the next couple of years, it might be tough sledding, and you got to check your allocation. And, if your goals have changed for this money, or you anticipate taking out a bunch of money for a particular reason, you need to have discussions. And also debt's more expensive. So those are all things to discuss with your financial advisor, saying, okay, well, my stuff is down and I'm also going to take on some debt and my debt is at higher interest rates. Should I do that? And how should I do that? And so there's some great conversations to have with your advisor to just say, okay, well, where am I at specifically and personally, and what sort of game plan do we have for that?
And I'll end on this. It's not us making a commercial for this, but it is prudent advice to say this is why you have a financial plan. You have a financial plan because the world changes. The world is different. And if you have a financial plan that was printed for you in a nice leather-bound whatever a year ago, guess what? That plan is very, very much outdated at this point. So talk to your advisors. Take a look at your plan. We're happy to update our clients' plans. We do it anyways. We want to go through it with you. If you're feeling trepidation, this is where those plans really, really have value, because It's in times like this where people go, does my plan still work? Yes, it does. We've planned for these times. Great. Okay. And if it doesn't, we need to make a few tweaks. This is the time to review that. So that's our little blurb for if you're feeling trepidation, call us. We don't know what's going on in your heads if you don't help us understand that. So if you're feeling concerned, let us know and let's sit down and review your plan. That is our recap of Q3. We will obviously do a year-end recap, long about January after the holidays. So everybody have a great fourth quarter. And we'll talk to you again on another episode of Gimme Some Truth.
Walkner, Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner, Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.